Hey, if you're looking to start a B2B SaaS business and you need to raise investment, you may be in need of a set of financial projections to present to potential investors. And if that is the case, you've come to the right place because we have built a financial projection template built specifically for B2B or enterprise SaaS businesses. And I'm going to walk you through how to fill this out, how the template works, and just kind of give you the detail by detail process here to create a set of projections that you can feel confident presenting to potential investors. But before I dive into the details of this particular template, just a little bit of background. My name's Adam Huxama. I'm the co-founder of ProjectionHub, and we help entrepreneurs create financial projections for potential investors and lenders. We have about 100 different industry-specific financial projection templates. Today, we're specifically focused on our B2B SaaS template, which is one of our top-selling templates, and I'm going to walk through how it works. So I put a link in the description of the video below so that you can grab the template. And at the same time, while you're down there, make sure if you find this video helpful to give us a thumbs up or subscribe to our channel. It really helps out a lot. So the last thing I'll mention, just a bit of housekeeping. If you stick around to the very end of the video, as a thank you for sticking around and hearing me drone on about financial models, we're going to give you access to a discount code to be able to get a discount on this template if you stick around to the end. So with that, let's go ahead and dive into how this template works. All right, so I'm going to start here on the at a glance tab. So this is kind of at the very end of the process after you have filled all the input tabs and all your assumptions out. You're going to get a 5-year profit and loss at a glance, some key summary data with some key KPIs related to B2B SaaS. So things like customer lifetime value, MRR, ARR, average monthly revenue per user, and so on. You're also going to get a few different charts and graphs that can be helpful for a pitch deck, or to at least be able to hand to a pitch deck designer who can take this and then pretty it up even more. You can also receive a 5-year income statement summary here, a 5-year cash flow summary, and a 5-year balance sheet summary. And then finally, you're going to get the income statement, cash flow statement, and balance sheet all broken down by month. There's a couple other tabs here that can be useful too that I'll show you. So there's what we call an investor dashboard. Now, of course, you can always just save a copy of this and send it to a potential investor, and they can get in and do whatever they want with it. They can make their own assumptions and see how the model changes. But at a very high level, if they want to just get in and make a few changes to some high level assumptions, you can come to this investor dashboard. And what the model is going to do is it's going to start by piping in the white what you put in based on all the assumptions you put into the model. In the blue, the investor could come in and put in their own numbers. They say, well, I don't think you're going to have 366 new customers. I think you're going to have 500 new customers. And so put that in there. And same thing with these expenses as a percentage of revenue. So this is what you've put in. We start as a baseline, just copying what you put in, but the investor could come in here and make their own changes to these expenses. And then what you'll be able to see is kind of the original income statement. So here's what you did. And then here is a modified income statement based on what the investor put in these blue assumption boxes here. So it's just a quick and easy way for investors to kind of play around with the model if you find that helpful. And then the last little tab I'll show you here, we partnered with a company called Equidem, which can provide business valuations. And they specifically focus on a lot of tech startups, which are valued in kind of a unique way. And so we have just produced this output page. It doesn't integrate or anything with their software per se, but it's producing this output in a format and giving you the numbers that you should need to be able to then input into their system to be able to produce a valuation. And you should be able to click this link up here to be able to get access to that as well. Okay, so that's kind of what the model can do, but we should get into the details here of how to fill it out. So let's step back here to our input assumptions tab. So any cell that's highlighted in blue is an assumption that you can change without breaking anything in the model. So you can put a projection start month, your opening cash balance. Let's say you invested $50,000 into the business to get it started, and you're looking to raise $1.5 million. So you can pick the month of operation that you expect that investment to come in. Can set accounts payable terms. So this just would be, when are you paying your bills? So let's say maybe some of your bills, you get them at the end of the month and then you have 30 days to pay them. Okay, that means some operating expenses can be paid on a 1-month delay. That could support your cash flow a little bit. So you can set this percentage here. You could just say, we're paying 100% of our bills all in the month that they're incurred. and that would be fine too. On the fixed asset side, you could add things like a trademark or employee equipment. You can set the value of that, the life expectancy in years. So how long is that equipment going to last? So maybe if it's a computer, we're probably looking at 4 years or something like that, right? You can pick what month here the purchase was made. You can also add loans. So let's say you have an existing loan. So if you have an existing loan, you'll want to put month 0 here. What that will do in the model is it'll make it so that you're still paying on that loan, but you're not going to receive the $50,000 in cash. So you're not going to get the influx of cash from the loan because this is an existing loan that you already have and you're already paying on. Now, if you put a month 1 or any month in the future for the loan, then what you're going to see in the cash flow statement and on the balance sheet, you're going to see that $450,000 as a cash influx. You're going to receive that cash in that month and then start paying on it. And you can set the interest rate and the terms, the number of months left on those loan payments. Now, this green box is something that you're going to want to come back to at the very end. So it's going to say, how much cash do I need? What it's trying to do is based on all the revenue and expense assumptions that you input, it's going to try to see how much working capital do you need? How much cash do you need in order to help you reach break even? So based on the numbers that I have in there right now, it's saying it's going to take 7 months to reach positive cash flow. And it's saying that we need $505,000 of working capital to cover our expenses during that 7 months it takes to reach break even. Plus, we're going to need this $40,000 for fixed assets that we put up here above, and maybe we need a buffer of $60,000. So total cash needs $605,000. Now, this box, if you have, let's say you've only put in your expenses, but you haven't put in your revenue, well, the model is going to say, hey, you never break even, right? So this is going to break. Your months until positive cash flow might say not applicable because you're never reaching break even. So it's not even going to know how to calculate, or it's not going to be able to calculate. So I would wait until the very end, input all of your revenue, all of your expenses, and then come back to this and double check. All right, let's look at the input revenue tab. So a couple things here. You can start off by saying, hey, we're gonna raise this investment, then we're gonna build the software, and then we'll start selling in X months. So you could put in revenue model start month 5, for example, because you don't think you're actually going to be able to start selling anything until month 5. You can then put in customer acquisition assumptions. So you have some different ways to potentially acquire customers. You might have some advertising spend with a cost per click that would drive website visitors. You could have organic website visitors that just organically are searching for relevant keywords for your software and find your website. So that gives you your total number of website visitors between organic and paid ads. And then you can set a conversion rate of website visitor to customer. So we set a 2% conversion rate, and that gives us our new customers from advertising and organic. Now this is typically for like a B2B or enterprise SaaS, you might have a sales team. And so we can set the number of sales reps that we're going to have, the number of leads we think each sales rep can talk to or kind of develop relationship with each month. And then a conversion rate of lead to customer. So on the sales rep side. And that gives us new customers from sales reps here. And then this is just kind of a catch-all. So if you just said, yep, and we're going to get some new customers from other sources, you can just manually put some of that in here. If you're already existing or you already have some customers, you could put in starting customers right here. And then here's where you'll put in your annual churn rate expectation. And ultimately, that's going to give you your total active customers in this line here. From there, we're going to say, okay, we have revenue from these customers in a couple of different ways. So we could do kind of professional services or setup fees or different services like a basic setup or configuration or advanced configuration that maybe your team is actually setting up the software and charging for that. So you can put in different start months where you're going to start offering those services, how much revenue that would generate, what percentage of these new customers are going to take advantage of these different service offerings, and then direct costs. So like, let's say, you charge a customer $3,000, you hire a contractor for $1,000 to help lead them through the configuration. So you could put in a direct cost for that contractor here. All right, now let's get to the main software as a service revenue here. So you can set different tiers that you have, what month those different tiers would start or be available. So as you iterate and build new additional features or versions of the software, you might have different tiers available at different price points. So you can set, okay, for year 1, starts in month 5, goes through month 12, we're only going to have tier 1. But then starting in month 13, we're gonna expand to 2 different tiers. And within that, you can set the percentage of your customers, of your active customers, so these customers up here, you can set what percentage of those active customers are subscribing at each different tier or level. You can set the monthly plan price, and then what percentage of your customers are paying monthly, and then the annual plan price, and this will be the percentage of customers who pay annually. You can also set the average number of users per customer. So if there's, this helps us later if there's some direct cost associated with the number of users that a customer has for you, we can calculate that later. So we want to know, does the average customer at tier 4 have 25 users on their plan? Okay, so that is going to allow us to produce our subscription revenue. And we'll also, since this allows for annual payments, or annual plans, you'll see there's a difference between, collecting the cash on an annual plan and when you actually earn the revenue. So you collect, 12 months of cash up front, but you're going to earn that 12 months of revenue over time, over each month divided by 12. So you're going to have a deferred revenue balance, and that is automatically calculated here for you and is going to be input on the balance sheet for you. You have this little section where you can just kind of a catch-all to put in other revenue line items that you might have. On the expense side, we give you the ability to put in a sales rep commission percentage here. And then other setup costs and other direct costs. So this would be things like AWS or maybe other third-party software that you're using. You can set a base monthly amount for these services. So you might know, hey, we're going to spend at least this much, but then we're also going to spend $5 per customer per month for their storage or for their compute. Or you might say we're going to spend 5 cents per user. So again, this was where this comes into play, this users per month. So you might know, hey, we have this third party, maybe it's a third party authentication software that's going to charge you 5 cents per user. It has to authenticate or something like that, right? So that could be what you might put in here. All right, so that is it on the revenue and cost of goods sold side. We have our other operating expenses here, and we can enter in different expense categories. So we've just got sales and marketing, general and admin, and development and maintenance or R&D, and you can put in different expense line items. You can enter in those specific expenses as a fixed dollar amount, a percentage of revenue, or a per employee expense. So a good example of a per employee expense may be, $500 on average per month per employee for remote office expenses. Maybe you hired a marketing firm for $1,500 a month as a retainer. But then what a lot of folks do is they might have line of sight in the first, let's say 12 months to be able to say, yeah, I know pretty well what my expenses are going to be in the first 12 months. But after that, after 12 months, it's hard to know. It really kind of depends on how well the business is going, right? Is it growing? And your expenses are likely to scale with your revenue. And so what we often do is we'll say, okay, let's put in general and admin, development, and sales and marketing expenses here as a percentage of revenue for years 2 through 5, and we can just set a percentage. So let's say here we wanted to say it's 5% for general and admin, 3% for development, 5% for marketing, sales and marketing. Now, keep in mind, this is outside of sales commissions because we already had sales commissions on the input revenue tab, and this is different than salaried positions. So a lot of your expense here probably is going to be on salaried positions. So let's take a look at that tab next. You can put in your different salary categories, job titles, select the category, put the annual salary in, set a employer tax, 7.65 in the US for FICA tax is the employer portion. You can set a benefits, employer benefits, and then what month that position is starting, how many of those positions you expect to have. So here's assistants. So we're going to have 2 assistants starting in month 15. And we expect to give a 5% raise here as well. Now, I will mention just one thing to note here is on the sales rep side, we have set, if you remember back here, we set the number of sales reps right here. So what this is going to do then is just set, it's going to pull from that and say, okay, well, the annual salary for those sales reps is $60,000 or whatever you put in here. So you don't need to set the number of sales reps on this page. And then we have this idea of a scaling staff team. So let's say you have some salary positions that you expect, well, we're just going to add as revenue increases. So we could say here, and you can set the dollar amount benchmark, but let's say for every 100,000 in monthly revenue, we're going to add another marketing staff person or another engineer. And you can set their salary as well as what month you want that scaling staff to start. So it could be that, hey, it doesn't matter what revenue is. Until month 15, we're not going to hire the scaling staff team, but after month 15, we're going to start that. All right, so that is it. That brings us back to our at a glance here, where we can see some key performance indicators and charts and graphs and tables. So I hope that's been helpful. If you have any questions at all, please don't hesitate to reach out to us at support@ProjectionHub.com. And again, as a thank you, as I promised, for listening almost 20 minutes in here, check out in the description of the video below, we're going to have a form that you can fill out and get a discount code to take a discount on this particular template. So hope that's been helpful to you, and let us know if you have any questions. Thanks.